through life's challenges. Transamerica is a company that is very experienced in the life insurance industry. We were founded in 1906. And in 1906, we were built to be a company that was different by design, very, very similar to WFG. And we've been on this mission for over 115 plus years to help families from all walks of life. And what we're going to focus on today are some of our core solutions that we use to help individuals. But when you look around the industry, a lot of people, I think they don't know much about life insurance. I think they know a lot about life insurance. If you ask the average person that you work with, the average client that you sit down with, if you ask them, what do you know about life insurance? Can you tell me how life insurance works? A majority of people, I think they would say, look, life insurance is something that I pay into on a monthly basis or an annual basis. I pay the life insurance company my premium. And then when I pass away, you write a check to my family. And I always kind of roll my eyes when people say that, because that is the version of life insurance that Transamerica rolled out in 1906. But a lot has changed since 1906. We're not living in the same homes. We're not driving the same cars. Life insurance is not the only industry that stayed stuck in the mud. So I want you to consider today to be an introduction to what life insurance should look like in 2023. Transamerica has been through it all. In the 1930s, we were the original termites, right? You still see those people out there today, the buy term, invest the difference folks. Well, we were the originals, right? We were the buy term people, but we've evolved with the industry. You know, in the 1980s, we introduced a new concept that's really, really popular today. It's called universal life. And the concept of universal life is that you pay in a premium and the company deducts the charges for insuring you. And then what is left over is going to grow in a separate account. And then in the 1980s, we took that money and we would grow it in accordance with some set declared interest rates. So if there's anyone on the call who knows much about interest rates or what they've looked like historically, if I asked you, what do you know about interest rates in the 1980s? You would say, well, compared to today, they were very, very high. So that was a real benefit that we could pass along to our customers. But that concept today is all but gone, because interest rates are historically low for a historically long period of time. So in 1997, we kind of saw the writing on the wall. And we built upon that universal life concept and we introduced what's called an indexed universal life, or IUL. And that's what we're going to spend a majority of our time talking about here today. The FFIUL is our flagship product. It stands for Financial Foundation Indexed Universal Life. It's been the number one selling IUL in the industry for 6 quarters in a row. And part of that is because we built the product the right way, and it's fantastic in the ways that it can help families. But the other part is because of our relationship with you, with leaders like Penny and Ben, the other leaders in this company. Our partnership with World Financial Group has never been stronger. We're a part of the same parent company that is Aegon. And if you look, Aegon has been very vocal lately at saying we are looking for growth with Transamerica and World Financial Group. So again, the time is right. Now is the best time to be getting into this business, because there's never been a more glaring need for what we do. And Transamerica has never been better prepared to meet that need. What we're going to focus on today is our 3 main product lines. And really, I want to focus on the FFIUL and term. I said at the beginning that we paid out over $595 million in commissions. If you want your share of those commissions, it's going to be by helping families with these 2 main solutions. The first of which is the FFIUL. And FFIUL, again, it stands for Financial Foundation Indexed Universal Life. So when you think of this product, I want you to think about establishing a financial foundation for families. And that's what this product does best. In order to establish a financial foundation with your clients, I want you to write down these 3 questions. And I want you to be able to answer these 3 questions when you're done sitting with them. Number 1, what happens if I pass away too soon? That's a key component of anyone having a proper financial foundation. Number 2, well, maybe more glaring to me is not what happens if I pass away too soon, but what happens if I live too long? Retirement has stayed kind of stuck at age 65, age 67. People are living longer than ever before, and you don't want to outlive your retirement income. So that's one of the key things that we help families with, is prepare for their financial future and answer that question, not of what happens if I pass away too soon, but what happens if I live too long. The third question to answer when it comes to establishing a financial foundation is, what happens if I get sick along the way? And we can also help people through our long-term care rider, our living benefits, which we're going to talk about. We can help people address that question. So I get a lot of newer agents who will ask me, well, Will, how do I tell people about Transamerica? How do I tell people what we do? I say we help people establish a financial foundation. We help you protect your most vital asset. That's you, your ability to earn an income, while also helping you grow and accumulate wealth that you can use towards retirement. So let's dive into a little bit of those details here. The first thing that an IUL is it's a life insurance policy. And it's life insurance first and foremost. And that's a good thing for 2 reasons. Number 1, people need life insurance coverage. There's a glaring need. About a third of the country has no coverage at all. So people are in the market for life insurance, but very few people are going to wake up tomorrow and say, hey, it's a beautiful Saturday morning in Southern California. I'm going to go buy the life insurance policy of my dreams. It doesn't work that way, right? Too often, maybe it's triggering life events that get people thinking about it. Getting married, having a child, purchasing a home. Sometimes it's negative life events, right? It's losing a loved one. It's having a critical illness. It's getting that wake-up call that, hey, this is something that's really important. And we want to make sure people know there are options before it's too late. So I love that it's a life insurance policy first and foremost. One thing that sets Transamerica apart, on the FFIUL, we have a benefit that is called the Everest Concierge Planning Rider. And this is pretty tremendous. If you ask most people who have purchased life insurance, what's the reason you bought life insurance? One of the top answers people will give you is, well, it's supposed to help protect my family with final expenses. I want burial and final expenses to be covered. Well, go to Google and type in, on average, how long does it take a life insurance policy to pay out? You're going to see that it takes anywhere from a month to 2 to maybe 3 months. That can be a long time. If anyone's ever lost a loved one and had to plan a funeral, it's a difficult process. And when I've had to go through this, we had the funeral a week after he passed away. Well, if my life insurance money doesn't pay out for a month or 2 months, how is it going to help me with the final expense? Transamerica has the ability to pay up to $25,000 of your death benefit in as little as 72 hours. So we're going to make sure that you get that money first and foremost to help with those pressing needs. So think about Transamerica and think about it as being a true final expense policy, that not many other IUL companies can say that. Now, in addition to being life insurance, there are some tax benefits that come along with this. When you receive money from a life insurance policy, you get it on an income tax-free basis. And that's pretty huge. If you talk to most people, and maybe you would say, look, not to be political, but who here is confident that tax rates will go down in the future? Right? Is anybody confident that tax rates will go down in the future? I find it very rare that someone would say that. But when it comes towards preparing towards retirement, a lot of people kind of religiously will put their money in what I consider to be a tax me later bucket. And if I'm not confident that taxes will go down in the future, why would I want to put my money in a bucket that is going to get taxed in the future? Life insurance gives you an opportunity for tax diversification. There are tax benefits to life insurance when you take money out, whether it's a death benefit or through a loan from your cash value. When you take that money out, you take it out on an income tax-free basis. And if I'm not confident that taxes will go down in the future, I don't want to be beholden to these tax rates when it comes to how much money I can receive in retirement. If taxes go up, I don't want my income to go down. Life insurance can provide a really tremendous way to achieve tax diversification. So here's the concept again on how an IUL can work. I pay in my premium. Let's call it $100 a month. The first thing Transamerica does, we take out the charges and the fees and the cost for insuring you. So I pay in $100. The $30, let's call it, for insuring me is deducted, right? It goes towards buying that big death benefit, towards getting that Everest rider. So that goes towards the cost for insuring me. The remaining $70 is going to go towards my index accounts. And that is money that is going to grow with time that I'm going to take out on an income tax-free basis down the road. So how does my money grow? That is one of the ways that Transamerica has separated ourselves from the competition. You can take confidence when you sit with your client that what we are best at is helping people accumulate wealth towards retirement. We have two different index account options that you're going to want to look at. One is the S&P 500. The other is the global index account. With the S&P 500, it's very simple. We look at the S&P over a 1-year period. However that S&P grows, you're going to receive a crediting to your policy based on the growth of the S&P. There are some limits in place, and we'll talk about those, but let's imagine that in my index account, I have $1,000. Well, if the S&P has grown by 10% in the first year that I have the policy, fantastic. I'm going to get a credit of 10% on my $1,000 index account. I'm getting credited of $100. Very simple, transparent, easy to monitor. I don't have to worry about any complex investment strategies. It's easy to track, easy to understand, and that's why clients really appreciate us. In addition to having the S&P 500, we also have the global index account. And the global index account is made up of not only the S&P, but also the Euro Stoxx 50 and the Hang Seng. These are three major indices. They're very developed, they're worldwide, and they're easy to track. I get the LA Times every morning. You're going to see this on the front page of the business section, what the performance of these three indexes has been year to date, over the last year, over the last 5 years. It's transparent. I know how my money is going to be credited. Now, I did mention that we have some safeties in place, and I really, really like this. Most people don't know that a solution like this exists. But when you look at active money managers, something that you should know is most of them, they don't outperform the S&P 500. And there's people who are very, very smart, who spend all of their time looking at the stock market, and they still get it wrong. But I can confidently tell you that I know there's three different directions that the S&P 500 or the Euro Stoxx 50, there's three different directions that it could possibly go when I look at the newspaper Monday morning. It can go up, it can go down, or it could go sideways. Those are the only three directions. We have a cap and a floor in place. Our floor is our guarantee. It means, Will, on a worst case scenario, we guarantee that your policy will be credited with positive 0.75%. It will never be credited with less than positive 0.75%. That means I don't have to worry as much about the down market. I'm never going to see that negative crediting. Instead, I get to participate in up or sideways. And really, sideways would be 0%. Positive 0.75% means I participate in up or slightly up. And in a volatile market like we've seen over the last 24 months, that can really help protect me. And I'll show you an example of the reason why. But a lot of people will stop me here and say, Will, pump the brakes. This sounds too good to be true. How can Transamerica do this? Well, you have to keep in mind, Transamerica is a part of Aegon, which is a global insurer, right? And we have billions upon billions of assets that we're able to invest in the market. We're able to buy complex options. But ultimately, what it comes down to is that we cap your growth. So you don't get to participate in all of the upswings of the market. On the S&P 500, we cap your growth at 12%. On the global index account, we cap your growth at 13%. So yes, you can participate in the upswings of the market, but on an annual basis, on a 1-year period, we are going to cap you at a maximum of 12 or 13%. This has worked out historically incredibly well for our clients. And the reason why, the more important feature is not the cap, it's the floor. The power of the guaranteed floor is critical. And I've talked with people over the last year who've had their money in the market and they've experienced significant losses. I've had people who've said, Will, my nest egg has been eaten away at. I've lost in excess of 6 figures in investments in the market. It's been terrifying for me. And a lot of really good financial advisors, they might tell you, hey, you just kind of got to wait it out, right? It was a bad year for the market last year, but it's going to turn around and, you just got to wait it out. And maybe that is good advice, but the downside is you've dug yourself in this hole and you have to overcome those losses just to get back to even. And I want you to imagine that you had a really bad year and you lost 30%. Well, if I've lost 30% of my principal, it doesn't take a 30% gain next year to get me back to even. I need to overcome those losses. I need to dig myself out of the hole. So it requires a 43% gain just to get me back to even. And that can take 2 or 3 or 4 or 5 years. The power of the guaranteed floor is, look, you're not going to dig yourself that 30% hole. You're going to start from above even and then participate in the upswings of the market up to that cap of 12 or 13%. So this is the type of solution I think that people would say, hey, this makes perfect sense. I just didn't know that it was available. And that's why we've had such tremendous success with WFG, because in addition to helping families with our solutions, you educate families. You tell people how money works, and it's important to educate people on the power of compounding losses. So I know that we've covered a little bit so far. Does anyone have any questions on the crediting of the policy and what we covered so far? We talked a little bit about the death benefit. We talked about the tax benefits. We've talked about the crediting. Are there any questions on what we've covered? Or is it okay if we move on to the long-term care rider, some of our health benefits within the policy? For those of you who are new, our next class next week, we are going to do a deep dive into the crediting of the policy. And we're really going to get granular with it. We're going to show an example of an illustration, exactly how it can work. So we'll go into much further detail here next week. Connie asked, can you please compare how much is premium charge versus how much they charge for mutual funds, et cetera? Connie, it varies. We have costs for insuring, right? Which mutual funds would have like management fees. So we have costs for buying you this insurance. It varies based off of how much coverage you're purchasing, what your age is, what your risk class is. So those numbers vary. But there is one big expense that life insurance does not have that mutual funds do have. And that's the expense of taxes. When you go to take money out, you get hit perhaps with a 30% penalty in the form of taxes. That's one that we're not subject to. So what I would ask is keep that question for next week, and we'll go into it in a little bit more detail here next week. Is that okay, Connie? Good question, though. Now let's keep moving forward and let's talk a little bit about those health benefits. And remember, I said at the beginning, when it comes to establishing your financial foundation, you have to answer 3 questions. 1, what happens if I pass away too soon? 2, what happens if I live too long? 3, what happens if I get sick along the way? And we've covered kind of the first 2, right? The way that the IUL helps with those 2. Let's talk about the third one. Long-term care is a real hot button right now in our industry. The reason why is about 70% of people who turn 65 are going to need some sort of long-term care support in their remaining years. The last number that I saw was about 14% of Americans have a long-term care plan. So 70% of people are going to need this, 14% of people have it. That's a tremendous gap. And I think about that gap and I think about how we are so uniquely positioned to help meet it through our long-term care rider. Again, this is life insurance for the modern age. Your old life insurance policy was a death benefit only. Today, your life insurance policy, yes, is a death benefit, but it also helps you build and accumulate wealth, and it also can protect you if you have a long-term care event. Our long-term care rider is optional. It comes at an extra fee, but the benefit it brings is invaluable. When you have a long-term care claim, the long-term care rider allows you to take your death benefit early. I can take up to 2% of my death benefit per month if I have a long-term care claim. It just reduces my death benefit. So let's say that I buy a policy and it's a $500,000 face amount. And almost immediately, I'm in a bad accident, I have a terrible back injury, and I can no longer perform 2 of the 6 activities of daily living. We'll talk about those a little bit later. But I'm on long-term care claim, right? When I go on claim, if I have a $500,000 policy, I'm going to take 2% of that per month if I choose to. So that would be $10,000 per month. So imagine that I have this big pool of money. It's got my name on it. It's a $500,000. It's sitting at Transamerica. I start taking $10,000 per month. And the pool of money goes from 500,000 down to 490,000. Then from 490 down to 480, then from 480 down to 470. So I have this pool of money that I can tap into. I'm able to spend this money any way that I see fit. So if I'm getting help in my home, I can reimburse my caregiver, but I can also put in a wheelchair ramp and pay the mortgage and make sure that we're still getting groceries and paying utilities. That's money that I can spend however I need to. So I really, really like the flexibility that this rider offers you, just an additional way to get value from this policy. The rider is available for our clients between the ages of 18 and 75. It's a minimum face amount of 100,000, a maximum of up to 2 million. And we're going to talk a little bit next week about how an increasing death benefit works. But this is something that separates Transamerica. I was at a conference, and this was a few years ago, but I was at a conference and they were talking about long-term care. And they said, the target market for long-term care has never been greater. The target market is going to be your clients age 55 to 65. And I'm thinking, wow, that's a difficult market to offer long-term care coverage to, not because they don't need it. They certainly will need it, but because it's going to be really expensive. And in addition to it being really expensive, it's going to be pretty difficult to qualify for, right? A 60-year-old maybe has some health challenges that a 30-year-old wouldn't have. But the reasoning being that they said the target market was 55 to 65 was you can more accurately count on the benefit and their needs. Here's the reason why. Let's say I'm 35 years old and I buy a policy today that is a $250,000 face amount. That seems right for me, right? That would help to protect my family if I were to pass away, replace my income, help pay the mortgage. I think we'd be okay with a $250,000 face amount today. And if I were to go on long-term care claim, remember, I can get 2% of that per month. So that would be $5,000 per month. So I would say, yeah, $5,000 a month is good for my family, and that would replace a lot of my income and would be just fine. But odds are, I'm not going to go on claim today when I'm 35. I'm going to go on claim 30 years from now when I'm 65. And what is $5,000 a month going to be for me 30 years from now? Today, it met all my expenses. 30 years from now, it probably won't. It's still $5,000 a month. I'd still be happy to have it. But the reason why people have historically targeted the older market is because of reasons like this, that you don't know with inflation what it's going to look like. Well, we have an increasing death benefit option. So if I select the increasing death benefit option, as I build cash value, my death benefit grows. So maybe by the time that I am 65 years old, I've been overfunding my policy, the performance has been good, my death benefit has grown. And it's not 250,000 anymore, it's 600,000. Well, now I can get 2% of 600,000. I'm going to take $12,000 per month. I have inflation protection that's kind of built into the policy in the form of my increasing death benefit. So I love that this could be a good option for younger clients, for people in all demographics. In addition to having the increasing death benefit option, which does set Transamerica apart, we've got indemnity style benefits. So with indemnity style benefits, that means there's two different ways we can pay a long-term care claim. One is reimbursement, the other is indemnity. With a reimbursement method, I would have to show Transamerica a receipt. And the receipt says, this month Will incurred $3,000 of expenses for his long-term care services. I would send in that receipt. Transamerica would see, yep, says $3,000. They would write me a check for $3,000. I am reimbursed. We don't do reimbursement, we do indemnity. With indemnity, that means, yes, I need to prove that I'm on claim. I want to see that, hey, costs were incurred, show us that receipt. But if we receive the receipt that says $3,000, it doesn't make a difference in how much money you as the insured will receive. If you have that $500,000 policy, you still get a check for 2% of the death benefit, $10,000. So use the $3,000 and reimburse the caregiver, and use the remaining $7,000 for whatever it is that you see fit. So I love the reimbursement method. No client will ever be disappointed in that reimbursement strategy. This, to me, is another feature that really does separate Transamerica. I talk to a lot of teams that position the FFIUL as the total care package. And the long-term care rider really completes the total care package story. So I hope this is helpful. Again, next week, we're going to go into a lot further detail on the long-term care rider, how you qualify for a payout, things of that nature. I'll pause here and we'll see if we have any questions in the chat. I do see one. Ping asked, is the 2% month of LTC payment tax-free? Yes, it is income tax-free. That's correct. Can the caregiver for LTC be a family member? Yes, the caregiver can be a family member. We recently updated this in our policy, so it's called informal care. We would want you to fill out like a timesheet that shows how much time they spend as the caregiver, and it would also need to be established in your doctor's plan of care. So if my doctor said, Will, it's okay, your wife can be your primary caregiver, then yes, we would accept that. Ernesto, I'm not sure I understand the question about how is paying the mortgage qualify as proof of loss. Again, when we want to see proof of loss, that is something that your caregiver can show. Hey, we charged you $2,000 this month. If you cannot show us proof of loss, you can show timesheets, and we accept those in lieu for like an unlicensed caregiver. So I hope that's helpful. Let's continue forward here because I've got a little bit more that I want to cover before we wrap up. Keep in mind on the long-term care rider, you do have to be life and health licensed in order to offer this. But what we're going to talk about next is our living benefit riders. And our living benefit riders are riders that come on your policy at no extra cost. And they are chronic, critical, and terminal illness. Again, this comes back to that conversation of what is life insurance in 2023 supposed to look like? It's not supposed to just be a death benefit. You're supposed to be able to use it as a living benefit. These riders allow you to take a payout from your death benefit if you have something like a chronic illness or a critical illness, a heart attack, cancer, stroke, organ transplant, or perhaps a terminal illness. So if you were to have a terminal illness, that means that you're likely to pass away in less than 12 months. You can accelerate up to 100% of your death benefit. And you can use that money however you need to. If you have a critical illness, you can take up to $500,000 or 90%. You can accelerate that and use it today. And if you have a chronic illness, you can accelerate up to 24% annually, up to a maximum of 1.5 million. The key feature with these riders, what I would start and write down, the more severe your illness, the more money you receive. The more severe the illness, the more money I'm going to get. The less severe the illness, the less money I'm going to get. But I want you to consider the fact that these are free riders. We give you an extra opportunity to receive a payout from the policy. We give you added flexibility. Again, next week, we're going to talk in a lot more detail about these riders, how they work, and I'll show you some examples of actual payouts. Now, in addition to the FFIUL, which is our flagship product, we've been offering term life insurance since the 1930s. We're very, very good at it. Term insurance is very popular. It's cost effective. It's the most affordable way to get the highest amount of coverage. It is temporary coverage, anywhere from 10 years all the way up to 30 years. And we have a very competitive product portfolio here. We have the Trendsetter Super. When you think of Trendsetter Super, I want you to think about super affordable. It is the most coverage for the least amount of premium. In addition to having the Trendsetter Super, we have a product called the Trendsetter LB. LB standing for living benefits. The Trendsetter LB is far more popular and it costs a little bit more than the Trendsetter Super. So why would I want to choose the Trendsetter LB? Again, because it comes with those same living benefit riders: critical, chronic, terminal, no extra cost, automatically included. This is so appropriate for today's world where people are living longer, they're not living healthier. The odds of you having a heart attack, maybe in the 1980s, you have this heart attack you would have passed away from. Today, because of advances in medical technology, you can recover. But it's at a very tremendous cost, right? It's very expensive. And I don't want something to be financially devastating and ruining to my family. That's where life insurance can come in and help me to overcome those losses. It's not meant to be health insurance, but it's meant to help out. A chronic illness is very similar to long-term care. You're unable to perform 2 out of 6 activities of daily living. You can accelerate up to 24% of your face amount per year, up to a maximum of 1.5 million. Remember our rule of thumb. The more severe the illness, the more money you would receive. Chronic illness is good. It is cost effective. It's not comprehensive long-term care. You don't get as much money as you'd get in long-term care. And it's not the same as health insurance, so don't confuse it. But imagine that you sit with someone and they tell you, you know, I already have life insurance. I'm already covered. The first thing you should ask them about, what are you covered for? And if they say it's just a death benefit, I would say, wow, we need to update that. That's old news. You have a flip phone from 10 years ago. We need to get you the new iPhone. And the reason why life insurance that's built today should have these critical and chronic illness benefits, because you're so likely to have one of them. The term policy that only pays out when you pass away, that's what we were selling in 1906. You need the 2023 version. That's one that comes with chronic illness. That's one that comes with critical illness. Again, a critical illness is something like a heart attack, cancer, stroke, organ transplant. You can accelerate up to 90% of your death benefit, and you can take that today as a living benefit. I mean, and I've worked with Transamerica for, this is going on 11 years now. I've seen the claims that have been paid. I've seen the individuals who receive checks for 200, 300,000 that allow their families to stay in their home while they're getting treatment. They don't have to move and have their kids change schools. A lot of people send sympathy cards or flowers. You can send a big check because you got them the right type of policy that is still very, very affordable. And then, of course, in addition to critical, we have our terminal illness rider. And it's the same as it was on the FFIUL. You can accelerate up to 100% of the death benefit if you're diagnosed with a terminal illness. That means you're given less than 12 months to live. Again, I don't want to get into the weeds here today. We're going to go into a lot more detail on these riders. I'm going to show you calculations on how they pay out here next week. So please, please, please join us next week. Now, the last product that we're going to talk about before we wrap up is our whole life. And Transamerica is really not a whole life carrier. But if you have older clients who say, look, I'm just looking for final expense, we are in that market. It's easy to qualify. We have face amounts anywhere from $1,000 up to $50,000. And for someone who is in their 60s, their 70s, and they don't want to leave a burden upon their family, this can be the right type of solution. So wrapping it up, we talked about IUL. We talked about how it can be that total care package, helping me, yes, with the death benefit, but also accumulate wealth and build towards retirement. And then when I slap that long-term care rider on, I have the total package. We've got term options that are very, very affordable and are more than just a death benefit, but solutions that were built with 2023's needs in mind. And then finally, we have some final expense options for clients that are older and in that market. If you would like more information on this, go to transamerica.com/agent-central. You can take a picture of this page. We have all sorts of frequently asked question guides there. We've got customer brochures. We have agent guides. We have underwriting information. Almost everything you could need is going to be found on that website. In addition, we have a sales desk. They're available Monday through Friday. You can call them with your product questions. I've got the number there below. Lastly, I'm going to put my contact information in the chat here. I want everyone to know that I'm very, very excited and privileged to be able to work with this team. I've gotten to spend a little bit of time with the leadership here. And I know that this team has very, very big goals in the future. We have big numbers we're trying to achieve in 2023. And I want you to view me as part of your team, as an extension, as someone who you can call. I'd be happy to set up time for us to meet one-on-one anytime that you need. So I put my contact information in the chat here. And then while you guys take that down, feel free to write any additional questions in. And then I'm going to go ahead and look and see what we have in the chat here. So let's see. Laverne asked, what happens to the CV while on claim? What happens to the credited interest while on claim? So Laverne, if that is in relation to the IUL cash value when you're on long-term care, it is going to go down proportionally. You can never have more cash value than you have death benefit. So your cash value would be depleted. Ping asked, is there an age limit to buy the term life insurance? Ping, yes, there is. It depends on the duration of the term policy. So you can view that and what it is, like it's a different age for the 30-year policy than it is for the 25, than it is for the 20, than it is for the 15. So take a look on that transamerica.com/agent central site. And when you go to the term agent guide, it'll have all those listed. Ernesto, I have not seen an updated LTC since 5/21. Where can I get an updated LTC brochure? Ernesto, you can get that from transamerica.com/agent-central. What you'll want to be on the lookout for is our informal claims, which is what we updated here last year. Duluce, what happens if the client has a terminal illness abroad? We can pay death claims internationally. We can pay long-term care internationally. The terminal illness rider, I do not believe pays internationally. So they would have to be in the United States at the time of one of those living benefit claims. Good question, but we will talk a little bit next week about how we can now pay long-term care claims internationally if they meet certain criteria. So I'm excited to share more on that. Well, it looks like